If you were focused on the headlines last week, you saw the market deliver a truly fascinating divergence. Silver roared ahead while gold fought tooth and nail to hold its ground. This dynamic leaves us at a crucial tipping point for the entire complex. Hello investors, stackers, and collectors, and welcome to your Monday Metals Market Update. So last week, we saw some exciting movement, particularly in silver, with it being up 4.32% for the week, while gold, even though we saw these gyrations at the end of the 5-day period, ended up 1.1%. Now, what really drove the market last week were these comments by Powell. So let's dig into what he said and how that's moving and going to move the markets going forward. One of the things he said is we are now likely in the vicinity of ample reserves, meaning that QT, or quantitative tightening, may soon end. The Fed now will not risk losing control of the balance sheet. And what's really important for us to understand is that Powell's pivot from drain to pause hints that the next big metals rally could ignite when rate cuts start catching up to this shift in liquidity. All right, so let's talk now more specifically so everybody understands what this means so you'll know how to position your portfolio going forward. If QT ends, if quantitative ends, and rates stay high, the effect on metals is mildly bullish. If QT ends but rate cuts begin, now we're talking. That is strongly bullish for both gold and silver. If QT continues and rates stay high, it's neutral or slightly bearish. But if inflation reaccelerates while QT pauses, that is super bullish, like flames, really very, very bullish. All right, so if you go back in history and we look at the price of gold as it relates to some of these time frames going back, you can see when we compare quantitative easing versus quantitative tightening, the effect that it has on gold. And I've put on the slide some of the different instances of when those were implemented. You can clearly see when we see QE 1, 2, 3, QE easing, you can see gold goes up. When we have QE tighten, it tends to go down. All right, now, in addition to that, I caught a tweet from our friend Josh Fair over at Scottsdale showing us how there was this massive injection of cash into the system. In particular, the Fed repo rate injections were substantial and indicate a sign of real stress in our financial system going forward. The implications are that the liquidity may precede a major monetary policy shift and should be viewed as very bullish for precious metals as its safe haven demand increases in the market. Now, I came across something new that I wanted to show you. I'm not 100% in belief of this, but I thought it was pretty neat, called the golden rule of gold investment. And basically, you take your age and divide by 2. So 2 examples, say you're 30 years old, you'd have roughly 15% in gold. If you're 50 years old, roughly 25%. This method balances your growth potential with safety, ensuring you're not overexposed to a single asset while maintaining diversification against your stock and bond real estate portfolios. I personally think it's also a really good indicator that as you get older, the proportion of your money should be moved toward gold. Now stay tuned because we've got some really exciting forecasts that have been updated that are coming ahead in the video. So let's talk for a second too about risk management as it relates. Gold is a diversifier. I don't think you should view gold as a core asset of growth in your engine, although we've had phenomenal growth over the last year and continue to. I still think we should keep it balanced as an allocation with other assets like stock, bonds, real estate, things like that. The triggers is that you should consider gold to be actually an investment, not a religion. You see this in Bitcoin all the time. No matter what's happening in Bitcoin, people are constantly like a religious fervor, like attacking anyone that says anything negative about Bitcoin. We have to be careful that we don't do the same as it relates to precious metals, in particular gold and silver. So we need to be focused on what's happening with the trends in gold, the pricing in gold, the ETF flow, what central banks are doing. Those things matter. Those are the things that should be determining what we choose to do in our investing. So while assets are untethered to cash flow, we do need guardrails. We need to be thinking, what are the things that are going to happen that are going to cause me to act moving forward? So now let's talk about some times when you would actually consider reducing your gold exposure. Scenario one, if we see people start bailing out of all their ETFs in gold and silver, that's a flag that tells us there's going to be a lot of downward pressure on the price of gold and silver moving forward. Number two, if we see that central banks start dramatically reducing their holdings in gold, that's an indication that we should also take a look at what we want to do. Again, follow what the smart money is doing. And then lastly, if we see the US dollar continuing to strengthen, that puts a little tailwind in gold and something we should be aware of. Now, we talked about a lot of different cases, what could drive gold higher. So let's talk about some of those things. These are the things that you should consider to leverage into gold and actually increase your exposure. So remember, when we talk about risk off, what that really means is when the market, for example, the stock market gets really hit, you'll often see gold and silver also very temporarily go down as well, partially because people are selling whatever asset they have that's still up. That will often cause gold and silver to go down and then immediately start spiking back up to the upside. Another thing is that if we see big policy shifts where people are increasingly getting out of the dollar, which we've started to see really happen, that's also very positive for gold, because when they move out of the dollar or treasuries, they tend to move then to gold. And then also we'll see sometimes with the miners that they tend to lag, right? So when gold goes up, you'll often see the miners go up, but after gold. That's another constraint and a very important thing to pay attention from an entry or exit point. All right, let's move to the charts now. Let's take a look first at gold. Number one, we can see that gold is not in a state of backwardation. It's actually in a state of contango. That's important for us to understand. We see now where gold broke through its 20-day simple moving average. But if you look back on the chart, what we're really looking for are crossovers. In other words, when that 20-day moving average crosses below the 50 or even the 200-day moving average. And you can see we remain still very much in a cycled bullish trend going forward. Even though we've seen gold come down, it's still dramatically above that 50-day moving average, which you can see now is around 38.18. So there's a long way to go down before we would consider gold to be actually entering what I would consider a more bearish market as we stand. Another element I want you to pay attention to when we look at this chart, when we look at the highs, this 4,300 or so that we got to, the difference between that and the 200 moving day average, you could see is quite substantial, right? That's over around, let's call it almost $1,000, that difference. When that number gets out, like really high against the 200 moving day, you'll often see it start to come down and kind of adjust. As you can see now, the difference between that 3960 and the 3200 or 3300 is substantially less. So there's room now for it to run back up. All right, let's shift now and let's go take a look at silver. Silver, kind of the same thing. We saw this massive divergence against that 200-day moving average. That's a big move, a lot of pressure for it to move back more in line with its averages. But again, if you look, we saw a cross way back here in May in silver. If you'd have stayed long at silver at around 32, obviously up here in the 48 range, you're looking very, very good. And as you can tell, even though it got close a couple of times, it still stayed above this 50-day moving average. And I still think very much speaks to it being a positive for silver moving higher as we move forward. All right, on the M2 money supply, again, the Fed is continuing to print money, very, very good for us in precious metals. When we look now at the Federal Reserve rate, it's starting to decline. Again, very, very positive for us with precious metals. If we look out to the December 10 meeting, we can see people are expecting a rate cut of about 65%, where roughly 34 are thinking it to stay flat. Why? Because of what Powell said, that he wants to see the data before he just starts to cut rates as we move forward. All right, unemployment continues to surge, that again is putting a lot of pressure on the Federal Reserve to continue to cut rates, to put money back into the system, to quantitatively ease as we move forward. Now, when we look at our federal debt, it too is starting to level a little bit, but still increasing moving forward. And when we go to our debt clock, we can remember that it was above that 38 trillion, remains there. If you just look at the digits, you can see it's actually increasing as we move forward. Let's move now to our forecast, which has clearly been updated from where we were last week. We're going to now increase it though. We're going to show what we're seeing for 30 days now and for 6 months going forward. I hope this adds more value to you guys as you look to where you want to invest. Now, we know last week silver was up this 4.3 and gold up 1.1. We're looking for corrective action. We're looking for things that provide strength in technical levels so we feel comfortable buying more, or whether we need to call Summit and decide we need to liquidate some of these hard assets. Now, if we look at gold, we see it has a support level of around $4,000. As I look at the current price of gold as we're recording right now, it's around noon Mountain Standard Time on Monday. We have gold just almost exactly at 4,000, at 4,001. Okay, now let's look at the near-term outlook for gold. And what we can see is we've got this resistance level down there in this band around 3,700. And a key resistance level as we move up around that $4,050 price. Some are projecting we're going to see it sell off some, bringing it down in the short term into that 3930-ish range. If we start to see that, they're saying this is a major opportunity to truly accumulate in this. I'm going to tell you that the forecast that I'm about to show you does not show us coming down that far. So you may be waiting there a very long time, much like the people were waiting at 2,000, go below 3,000. Now we're up around the 4,000. So we'll see what happens going forward. But I actually think we're unlikely to get down into these deep zones. All right, now let's talk about the actual projections from my proprietary systems and what they're showing moving forward. There's going to be two for silver and 2 for gold. For silver for the short term, we're projecting silver to have a pretty dramatic rise up around $7 an ounce, up into that 55, which would be an all-time high. Our model, my model, is showing an expected jump of about 13 to 14% moving forward. If we move out to that 6 month, we're moving the target up, and not so dramatically more, but up into that 61. Again, an all-time high moving forward, because we're seeing these key milestones likely to be broken, that $52 resistance, consolidate around 55, 57, and then drive up into that 61 number as we move forward. As it relates to gold, we're sitting now at around 4,000, 4,003 an ounce. It was 4,010 when I created this slide. You can see that over the 30 days, we're projecting it also to have an increase of about 10% around that 4,400, which is that all-time high number where we're going to see. The key is, are we going to see it go past that 40.75 resistance, and are we going to see the Fed pause QT, quantitative tightening, and move into quantitative easing? All right, for the 6 month, this projection remains exciting, but has come down from where we were in weeks past. So clearly we're seeing some changes in our underlying models that are causing us to lower our future forecast of gold going forward, but yet still very, very strong, up another 23%, now showing at around 49.42. The milestone again is breaking that 4,200 level, consolidating 44 to 45, and then moving up into that 4,900 as we see rate cuts and quantitative easing. So that's our presentation for today. Thank you so much for joining. Please like and subscribe. We really appreciate you and look forward to talking to you next week. So happy stacking.